Hey, what's going on, guys? So I want to put out this video because I'm getting this question, left and right from different locations. And so this recording right now, this is not pre-scripted or anything like that. I'm just kind of going off cusp here, but I want to talk about when is the right time to run a policy at Target, when is the right time to overfund. Some people will watch some of my videos and they'll watch maybe 3 minutes of it and they'll make a decision just based on those 3 minutes. And they won't actually watch the entire video and understand the reason and the rhyme behind it. And one of the number ones that I get is, you know, Tony, why are you overfunding policies? Or Tony, why are you running it at Target? That's the wrong way to do it. And if you talk to this group of people, they're going to argue with you up and down, left and right, why everything should be overfunded. If you talk to this group of people, they're going to argue with you left and right, why everything should be done at Target. And at the end of the day, when you start having a conversation with them and you find out how much of your content or how much of my content did they actually watch, it was only just a couple minutes, and now there's a blanket opinion that essentially is made. Here's my comment. Here's my response to all of this. And I'm going to take this video to kind of explain the reason and rhyme as to why I recommend certain policies be ran at Target, certain policies be ran overfunded. Okay. The devil is 1000% in the details. The devil's in the details. Okay. I will throw out this disclosure. Every single client should be properly fact found. Every single client, you should first meet with them before making a carrier recommendation, a monthly budget recommendation, a product recommendation. You really need to figure out what are they trying to accomplish? What are their time horizons? What are their goals? What are their risk tolerances? Is this person's personality going to be more suited for a whole life versus an IUL? Do you see this person and their past habits, their current habits, and the potential future habits of being someone that could overfund and put more dollars in the future? Or do you see this person as someone that's kind of hit their cap as to how much they're able to put in? Okay, so there's so many variables that are going to go along with a final recommendation. What I'm going to give you is more of a guideline in my 19 years experience where I've said to myself, you know what, out of every 100 clients that I meet in this age bracket, the majority of them are in this particular situation. Out of every 100 clients that I meet in this age bracket, the majority of them are in this particular situation. Out of every 100 clients that I meet in this age bracket, the majority of their situation is in this bracket. And so when you come across those generic situations, this would be what I would recommend, assuming all these variables are in line. Okay, so let me talk about the very first one. The very first one, the most like, Tony, why are you doing it this way? Well, because you probably only saw 3 minutes of my video, right? Why do I run certain policies at Target? Let me be very clear. I will run a policy, an IUL policy at Target when the client is young. When the client is young, and I'm going to tell you my reason and my rhyme and my why. Okay. Would you agree most people when they're young, we're talking about 20s, right? Um, teens and 20s. Number one, they probably have not gotten to their maximum income potential. Most people would say to me, you're right. When I was younger, I wasn't at my max income potential. I was still either going to school, still trying to figure out what I wanted to do, still at home with my mom and dad, still trying to get my career developed, still trying to get my business developed. Number one. Okay. So that is one of the criteria that I look for when I decide to put things at Target for a 20-year-old. Why? Because I want to make sure that the policy that I'm building them has the maximum potential of putting more dollars in the future because I know where they're currently at. It's just not enough. They're not making enough. They're not making their maximum potential. Most people in their 20s are going to probably commit to 100, 200, maybe $300 a month into a policy. Next question. Do you believe that 100, 200, or $300 a month is going to retire somebody? The answer is no. Then guess what? I'm going to design a policy that'll allow them to put 400, 500, 600, 700, 800 a month later on when they're making more money without having to reapply for a new policy and risk qualification, without having to reapply for a new policy and take into consideration the new age bracket that they're at. And so I want to make room for the first policy, knowing I'm not going to make a commission later on just by selling them another policy. I want to make room so that they can put additional dollars in to meet those or get closer to those retirement goals. So again, number one, Number one, right? Is the young client at their max income? Number two, if you agree with me that most people that are young are putting in 100, 200, 300 bucks a month, again, we're talking average, right? So out of every 100, 80 to 90 of them are in that sector. Yes, there's that occasional guy who's killing it in his early 20s, making, six figures, almost seven figures, who could put away a lot more money. But the majority, the general consensus is that they could probably afford 100, 200, 300 bucks a month, right? If the answer to that is yes, then you have to ask yourself the next question. Right? Oh, one too many M's. Will $100 to $300 per month meet someone's retirement goals? Right? If the answer to that is no, there's no way, then I want to design the policy at target so that I could put more dollars in later in the future. Simple as that. Number three, target is also equal to face value. The higher the target, the higher the face value. Higher the target, higher the face value. So here's my next question. Younger people tend to have a higher probability of having younger children, right? When I was in my 20s, that's when I had my 1-year-old and 2-year-old and 3-year-old in regards to my children. In my 40s, I got my teenagers. And so when you think about income replacement, if someone dies, I want to replace a good majority of my income. And if I had to determine the time period that I wanted to replace, I probably want to replace until my youngest is 18 years of age and out the house. And so when I look at a 20-year-old, a younger 20, 21, 22, 23, and I'm acknowledging all of these things right here, the majority of them, again, I'm talking general, are probably starting families. They probably have those younger kids, which means they probably have a pretty high death benefit need. They probably have a high death benefit need. And so I'm more apt to running it at target for them because I want them to have a high face value, right? Because they have more income, more time to replace if they pass away until the youngest hits 18, because I know that 100, 200, 300 bucks a month is not going to retire them. And because I know that they're not at their max income potential, I want the policy to allow for more dollars to go in so that there's a better chance at hitting their retirement goals. There's more room for their future income that's going to increase, and there's higher face value for that younger family because they have the younger children. Those are some of my reasons why I choose to take policies for people in their younger ages and run it right at target, right at target. Here's number four. Would you agree with me that most people in middle America, they're going to retire, as much as they want to retire in their mid 40s and 50s, they're probably going to retire in their 60s, especially in the middle American market. Okay, what does that mean? A 40-year-old probably has 20 years before they hit their 60s. And so they have only a 20-year window to do something positive with an IUL. And because they've only got 20 years, right? The rule of compounding interest, rule of 72, whatever you want to call it, you should overfund a 40-year-old's policy. You should definitely overfund a 50-year-old's policy. But a 20-year-old has about 40 years left before they get to their 60s. So they have something in their corner that the 30 and the 40 and the 50-year-old don't have, and that's time. Would you agree with me that the average 20-year-old, 21, 22, 23, 24, right? This is just math. This is hard for you not to agree with me on this. Would you agree that they've got about 35 to 40, even 45 years before they're going to knock on the door of retirement? And that time, that compounding interest of time allows for the policy that was designed at target to really hit its maximum potential. Because they've got it, I repeat to you again, they've got 30 to 40 years where every 5 years they can increase their contribution. See, here's a big mistake that a lot of people make with IULs. They think the dollar amount that's going in is the only dollar amount that should go in. When I design IULs, I show the client what it looks like if every 5 to 10 years they increase contributions and increase contributions and increase contributions and increase contributions and get themselves to a place where they're max funding a policy. Do you know why I'm not going to take a 20-year-old who can only afford 100, 200, or 300 bucks a month and design it from the very beginning, max funded? Because when they can afford to put 500, 600, or 1,000 bucks a month, the policy's already max funded and risking it to become a mech. And so I would rather run it at target so that when they can afford those bigger numbers, they can do it. I don't want to put them in a position where all of a sudden they're uninsurable because of some medical reason. They're making more money. They know they need to put away more money to hit their retirement goals, and they can't because the first policy that I sold them was already set up max funded. I definitely don't want to be talking to the beneficiaries if something happens to that 20-year-old and looking at the surviving spouse and being like, man, I'm so sorry, you have a 2-year-old and a 3-year-old. And we only got them a small amount of insurance because I max funded the policy, and then therefore we're only really going to be able to replace 2 to 3 years worth of your income instead of what your spouse probably really wanted to do. Now, yes, some people can argue and be like, well, what about a supplemental term? You can always add to it. I get it, guys, I get it. I'm sure 50 of you guys can come up with 50 different reasons why you would do it this way versus the other. I'm talking generic. That's why I say to you, the average 20-year-old, 21, 22, 23, 20, the average 20-year-old, even the average 30 and 31-year-old, most of these questions you guys would answer the same way that I would answer. Most of these questions you guys would answer the exact same way that I would answer. And if you don't, I really wish for you to comment and let me know what you think the generic 20, 25, 26-year-old situation is. Because in my 19 years, this is what I've seen. The generic 20, 21, 22, 23, 24, 25-year-old can put more away per month later on because they haven't hit their maximum income potential. They're making more money in their 30s. They're making more money in their 40s. I'm a product of this scenario. In my 20s, I couldn't put away 1,000, 2,000 bucks a month into my own IUL. I couldn't. My budget only allowed for me to do a small amount. Why? Well, number one, my career had just gotten started. I wasn't making a lot of money. Number two, I had a crap ton of responsibilities, diapers, baby food, formula, responsibility over children, right? Those expenses are almost the highest when they're the smallest. Daycare, after school programs. So I couldn't afford that stuff. So not only is my career not thriving and I'm making, the maximum money that I possibly could, but I got the most amount of financial responsibility. So I had no choice. I had to have I had to only do 100, 200 bucks a month. I still would have recommended that the 20-year-old version of me have a policy set up on target. I still would have recommended I would have picked up $1 million of term insurance at 15 bucks a month. Why? Because when I'm in my 30s and I can afford to put more money, I would have rathered my initial policy that was already approved at a highest health rating, had the room to fit more dollars in than just the target that I was putting in. See, here's the thing, and I'm going to close with this piece right here, okay? Here's the thing. A lot of agents make the mistake into thinking what you put into a policy in the beginning is what they're going to do the entire time. I see so many illustrations where it's like, oh, Mr. Client, you're committing to 300 bucks a month. So they run 300 bucks a month all the way until the client turns 65. And I'm like, why? When you know good, God, and well that this policy has the window to put more dollars in. So why don't you show them that? See, when I meet with a client, I'm going to show them 2 illustrations, but it's the same policy. One illustration is a level contribution. If you signed up for 300 bucks a month, let me show you what 300 bucks a month does for you all the way till 65. But let me show you this other illustration. And it's the same policy. What if you do 300 bucks a month for the first 5 years and then go up to 400 bucks a month for another 5 years, and then go up to 450 a month for another 5 years, and then 500 bucks a month for another 5 years. And every 5 to 10 years, I increase the contribution and increase the contribution and increase the contribution. Why am I able to do that for a 20-year-old or a 22-year-old or a 23-year-old's policy and continue to increase like that? Because I ran it at target from the beginning and I allowed for max contributions. Now, if my client's in their 30s, my rule of thumb is overfund by 30%. Overfund by 30%. My clients in their 40s, overfund by 40%. My clients in their 50s, overfund by 50%. And if my client's in that mid-50 bracket or higher, you need to be overfunding by 60%, and you need to be running that death benefit at level. At level. You don't need to be running an increase of death benefit. You need to be running it at level. Most of the 55, 60-year-olds are already at their maximum income potential. Most of them don't have a huge need of insurance. They need cash accumulation. And listen, a lot of the times, The IUL isn't what makes sense for that 55, 60-year-old based on what they're willing to put in. I come across so many agents that are like, well, my client only affords $300 a month and they're in their mid-50s. I'm like, then don't send them an IUL. Put that money somewhere else. Invest that money somewhere else, because the one thing these strategies need, time and a surplus of money. I want to give the 20-year-old room to put that surplus in when they're making the kind of income that justifies them putting it in, because I know they have the time already there. They have that already there. So if you've watched some of my videos and you've only watched 2 minutes of it, 3 minutes of it, and you're like, is he designing this illustration at Target? This guy doesn't know anything that he's talking about. Watch this video and tell me if you don't agree with me in reference to these topics right here. And then feel free to shoot me a message and let me know. I'm willing to have a very professional conversation with you and hear your point of view. Here's one thing I do know. There's a lot of different ways to get to Rome. This is my justification. It's a valid one that I can almost guarantee you most people will agree with me on. They will agree with me on. They'll agree that a 30-year-old should get overfunded from the very beginning at 30%. And they will agree with me that a 40-year-old should get overfunded by 40% and a 50-year-old by 50%, which means that a 20-year-old, it's okay to run it at Target for these very reasons. Shoot me a message. Let me know if you agree with me. 239-784-1118. Comment on this video. Tell me if you agree with me, if you don't. I'm okay if you don't. Just do me a favor and back up why you don't. Tell me why these reasons right here are not valid enough reasons to set up a 20-year-old at a Target policy and then sell them a supplemental term insurance on the side that costs them 15 to 20 bucks so that they have the right amount of insurance that they need, but they got a policy that's ready to hold a lot more money in the future when they're making more money. Have a good one. Be blessed. I look forward to hearing your comments.